Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, January 7, 2015. And you're looking at a daily chart of the SPY. And in last night's video and the video before, on Monday, I told you that Wednesday would be a short-term cycle turn date. And since the market was headed in a downtrend, that means the turn date would be a turn up in the market. And that's exactly what we saw. We saw an update today by about 23 points in the S&P and about 212 points, almost 213 points in the Dow and 57 points in the NASDAQ. So that played out, and there was a couple of other markets that were indicating a turn day as well, and those would be the bond and interest rates, and that kind of turned a little bit, but not really, but it's got the makings of a turn. We'll see what the next day brings, and remember, all turn dates are always plus or minus a day, and as it stands today, it's today plus 1 day because tomorrow's already over, so we'll see what happens tomorrow with the bonds and also the U.S. dollar. The dollar was still up today, so that didn't turn yet, and it may not, but that's okay. We were more focused in the stock market anyway, and we definitely had the turn. So today marked, or yesterday to today, marked a daily bottom in the stock market. That doesn't mean it goes straight up from here. Doesn't mean we make new highs out of this bottom. All it means is usually this will hold for a few days. Maybe 2, maybe 4, maybe 5, maybe 6. We'll see what happens. We'll play it one day at a time, and we'll take it, slow, right? We don't necessarily try and predict the future. We just let the charts tell us what to do. And right now, the charts are telling us that we bounced off this bottom, which is usually good for a few days. So where does that mean we go from here? Well, if you look at the daily chart, you can see that the 20-period moving average, which is the red sloping line down here, and the 50-period moving average, which is the blue sloping line up here, are converging. And certainly the market could use that as a target, which is also currently this high here from the 5th of January. And the high here is 204.37. And these right now are about 204 and 40 and change. But this will slope down over the next couple of days, and this one will start to flatten out most likely. And so the 20-period moving average moves faster than the 50-period moving average. So these are going to converge by tomorrow or the next day, and that's going to provide a level of resistance, as will this high here from this red candle down day. So the market's going to have a difficult time getting through this high at 204.37. It has to close the day above 204.37 to go on to the next level, which would be up in this area here. Now, it also has to do it on volume, right? So this day you had almost 170 million shares, and today you had 125 million shares. So right now you didn't have enough juice to close above this line. Not that we were there today, but it wouldn't have happened anyway. And basically, we have to be up on volume. So let's look at the intraday just for a second. I'm going to look at the hourly, and you're going to see much of the same thing, but you can kind of zoom in and see what we're talking about. This happens to be a bullish pattern developing, and in order for the market to go on to the next level, which is up here, okay, that's that same 204.30, what is it? 204.37, okay, you have to first close above this level here, which is 202.58, and today we closed at 202.37. Okay, so just to give you some numbers and idea, you have to close above this red bar high here in order to move on to the next level, and that's where you would find some resistance in this area and the 50-hour moving average, right? This is the 50-period moving average on the hourly chart. This will continue to slope down, and you're going to find a fair level of resistance in this neighborhood right here when we get there, if we get there. So can we get there over the next day or so? Absolutely, sure. We'll see what happens. We'll play it one day at a time. But so far, so good. We had a daily bottom really yesterday into today, this morning, and then the market took off. So we'll see what happens from that point. All right. One of the indicators, I like to look at is the IWM. And if we look at the IWM on a relative basis, today it was about the same as the S&P. The IWM was up... what was it, about 1.6 1.7%, I think it was. I'm looking on another screen here. Just bear with me. I'm sorry, 1.3%, and the SPY was up 1.35%. IWM exactly was 1.31. So all in all, that's the same relative strength. So it's not giving you an indicator that it's either weaker or stronger than the S&P. It performed about the same. So we don't really take much out of that. We just move on. And let's move on to a different market, okay? There's not much to discuss in the stock market. Up day, daily bottom, cycle bottom, and we go on from there. So let's go over to the gold market, and we'll look at the GLD. And if we look here, we had a little bit of a pullback in the GLD. Spot gold was down about, I think, $6 or $7 today. That's not a lot, but all in all, it's a down day. And remember I told you that my target, originally on Monday, I said my target for January was to achieve the level on spot gold of 1240 to 1245. Right now, in the overnight session right now, we're at 1213. We finished the day here about 1210 roughly. So we were down from yesterday, but you would expect after 3 up days like this, you would expect some kind of a breather in the market, and your first stop and that 1240 some odd area is going to coincide with about this 119 in the GLD. So you may go sideways for a few days and then try it again. And all in all, my work is telling me that we should achieve that number. By the way, or higher prices, 1240 to 1245 or higher within the month of January. So on weakness, I think you can certainly buy gold. And what would you use as a benchmark right now? Well, if you wanted to give it a lot of room, you would use this low here at 112.32 on a daily close below 112.32. That would be no good. But on a shorter term basis, as long as you stay above the 50-period moving average on a daily close, I would be good with that. And right now it's at about 114.52, but that's going to move a little bit each and every day. So that's just a snapshot in the gold market, but we may see lower prices within January, but I do have a target of January for 1240 to 1242 or 1245 or higher in this month. So keep that in mind, and we'll play it by ear, and we'll see what pattern the market forms and tells us what's coming next. Again, we always let the market tell us what to do. We let the charts tell us what to do, never impose our will on the market. Let's look at the USO, which is the crude oil market. And, it was a little bit of an update today on decent volume, but all in all, the oil market was up, I think, about 80 some odd cents today. Right now in the aftermarket session, we're at over 49. We're 49.05. I'm looking at the February contract on crude oil, but that's not much of a rally. I mean, folks today were trying to say that part of the reason for the rally today was the rally in oil. That's not true. Oil's down over 50% over the last 8 months, okay? And the market was up most of that time. So all of a sudden today the market's up because gold went up, oil went up, 80 cents or something like that during the day. That's not true. That's just nonsense. That's not a correlation. Everybody always wants to find the reason why the market was up and look for a correlation and say that's the reason. That's not the reason. They just happen to both be up today. And remember, I said, yes, today was a cycle bottom in a few markets, right? I originally told you the stock market, I told you bonds and interest rates, and the U.S. dollar. And maybe it was a cycle bottom for gold. I didn't see it. Oil. I keep saying gold. Oil, crude oil. But I didn't see it, but that doesn't mean it didn't happen. So maybe today was a bottom for crude oil. We'll see how that plays out going forward, but I certainly don't see a definitive bottom, and until we do, there's really nothing to do in the energy sector and specifically crude oil. So nothing's really changed on that front. Real quick, let's move over to bonds and the interest rate market. TLT is the 20 to 30-year Treasury bond. It's an ETF that tracks the 20 to 30-year Treasury bond market. And it actually finished down slightly today. TLT was down 26 cents today. That's not much. It was down much earlier. And then the Fed came out and with their notes from their last meeting and said that don't expect an interest rate rise before April. Well, everybody knew that nothing was going to happen before then anyway, if they even have the guts to raise interest rates. And keep in mind, the Fed doesn't control long interest rates. It's certainly not any longer, because while they were buying bonds through all their bond purchase programs, QE this, QE that, QE this, they did control by sheer fact that they were buying longer dated bonds, but they're no longer buying bonds. Therefore, the market solely right now is going to determine what the price of all bonds are, except the Fed funds rate, which is the only thing that's good for, is the overnight bank-to-bank borrowing rate, or borrowing from the Fed. Okay, so if a bank wants to borrow from the Fed, they're borrowing it at the Fed funds rate, which is next to zero, and that's all they really control at this point. So the market is going to determine what the rate of the bond market, or long-term bonds, intermediate-term bonds, is. So if you look at the actual interest rate, this is TNX, which is the 10-year interest rate, okay, you can see here that there's no sign of a bottom, there's no definitive bottom, it's just basically real low, right? So where are interest rates? 2.51, oh, I'm sorry, this is the 30-year, excuse me, this is the 10-year, TNX, that was TYX on the 30-year. TNX is 1.954 to borrow money, or I'm sorry, lend the government money at a 10-year rate, 10-year bond. They're paying you 1.954% today. That's essentially what that means, okay? So look where rates are. I mean, this is as low as they've been in a long while. And there's no definitive sign of a low, although this could be, you could make a case this was a bottom, and I said that last night. But until we see some kind of volume off this to the upside, we can't really say that it's a bottom. We'll have to see. We'll play it one day at a time. Doesn't really matter. It's just something to look at. It's another proxy on the markets. The last thing we're going to look at tonight is the U.S. dollar, and I'm going to look at the UUP, which is the ETF that's a proxy for the dollar. And while the dollar was up slightly today, UUP, where did UUP finish in terms of price? Let me just look on another screen because I can't see it from the chart. Yeah, UUP was up 2 cents today, 2 pennies, and that's not much. But look where this is. I mean, if you look at a longer-term chart, this is in the middle of a parabolic move, right? The dollar. Okay, look at this. So let's even look at a monthly chart, all right? You'll get the picture. On a monthly basis, okay, this UUP is going to head higher, not all in one shot, okay, but you're certainly going to come and challenge these highs in my book, okay, because if you look at a chart of the U.S. dollar, and I don't have it on this platform, but if you look at a chart in the U.S. dollar, which is trading at $92.22 right now, $92.22, okay, the target for the U.S. dollar is in excess of 100. We're going to look for at least 103 in the U.S. dollar this year, okay? So there's plenty more upside to be had in the U.S. dollar, and a case could be made that that can put pressure on oil, and that is putting pressure in the crude oil market, because don't forget, all oil purchases have to be converted into U.S. dollars, because on a global basis, all oil is purchased in U.S. dollars. Therefore, if the dollar is stronger and you're converting from another currency, you're essentially losing value of your currency on that conversion as the dollar moves higher. Okay? So that's one of the reasons that there can be a case that the reason for the weak crude prices is strong U.S. dollar. That certainly makes a lot of sense to me. Okay, so that's about it. Let's just go to the daily chart one more time. And while the dollar didn't really move much today, the dollar should have, or should be putting in a daily top, today plus 1 day, and we'll see how tomorrow plays out, but it's got to kind of move back towards this 20-period moving average. I call this close to home. This is home base. The 20-period moving average is home base. Once you get too far from home base, any market likes to come back home. And if you can see how the market will generally hug this 20-period moving average up or down, okay, and it gets a little bit too far, comes back home. Gets a little bit too far, comes back home. We're getting a little bit too far. We're going to come back home, and we'll see what happens over the next few days. Hopefully this is helpful, folks. I know this was a long video. I apologize, but it's good information, and you can learn something from this stuff. So I'm David Frost, MyStrategicForecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.